Thanks again, Matt and Zach, for having us here today. My name is Charles Wong, founder of Lightning Capital, which is a fund focused on this space. So we're probably one of the few institutional investors here today. Just give you an idea, I've been orange pilled since 2013, so I understand this space well. We started mining this in 2019 and then eventually shut it down to focus on the fund side. Our questions are, what we would like to hear is, who do you see as your biggest competitor? And then the second piece is, you talk about expansion, you talk about, I think you're getting machines at the price you got per terahash is amazing. But what do you think that price point is much higher? What are you thinking about going forward on expansion as we go through this? I mean, we believe that we're going through a cycle, but we don't believe in the super cycle, meaning we go through this peak and then we're going to collapse again. And so when you think about our investor dollars, how are you thinking about that expansion?
Yeah, so we're currently long machines, and that was done on purpose, right? So we secured 160,000 S21s, and we did it in January, knowing that we was going to be delivered over time. And we bought machines for shelf space we don't currently have built or own yet, because when asset values fluctuate in bull cycles, it's the servers that fluctuate the most. And so I don't think that we will have quite the price shock that we had in the last cycle, because there was supply chain, COVID, everything on top of a bull cycle. And then also I think that there was a lot of new dollars flowing in the space that won't be flowing back in. And that's going to be because I think capital will be fleeing to quality. So what we wanted to do is, at halving, be long machines, be a top 4 miner, and we ended up higher than that, because I'm a real believer in the flight to quality of capital, which will make our capital costs cheaper. It will make it easier for us to acquire facilities at the right price. Facilities may get more expensive, but they're not going to get more expensive in the way that miners are. So that's the first step. Now, to go back to one thing about competitors, our competition is global hash rate. It's not really any single name, except when it comes to capital, because we're not competing for customers. It's ultimately capital. A term that got used in the conference I was at yesterday on the panel was, there's the haves and the have-nots. That's really what it's going to be. There's going to be companies that have access to large amounts of capital at low cost, and then everybody else, which their only access to capital is either they don't have it or it's a very high cost of capital. So I think that's going to give us a tremendous advantage. So the competition, from my point of view, when I think of capital, is the top 4. I think it's imperative that any miner that wants to be around in a meaningful way in the next 4 years needs to be amongst the top 4 in market cap and volume from a trading side. I think that there's over 20 publicly traded miners right now. I think 13 of them disappear within 2 years. I think we're down to 7 or less. And I know that might sound like a bold claim, and they may still exist, but nobody's going to know who they are, right? Or they, again, won't exist at all. They'll be bought up. They'll be consolidated into. And those top 4 are going to be the only ones I believe that will be empowered to do so. So I'm less worried about any specific name, and I'm just more worried about positioning, because positioning is the power, not any one thing that's specific. I think it's important too, just kind of going back to the whys, having portfolios, not a single site, having growth prospects. It's going to be about portfolio management in the next 4 years. That's going to be also a huge competitive advantage. And happy to dig in anywhere else. But that's how I'm thinking about the machines, how we're going to control our capital cost. We really don't need to buy another machine, is what it comes down to, inside of the next 12 months.
So that's great to hear. Yeah. Based on that portfolio management, I think you're thinking probably of Treasury Management too. Yeah. How are you thinking about that going forward?
So Bitcoin, of course, is an important part of Treasury Management. It's an asset. Now, we've always followed a counter-cyclical approach. You notice that the chart that Matt showed earlier, it started in April. Why did it start in April? We started saying, hey, the tides are turning, but it was in June that we really doubled down. And that's when we quit selling the majority of our Bitcoin, because we'd sold all the way down to 0 before, and we'd have a little bit at the end of every month, and we'd sell it off. And we felt like the tides were turning. Strategy over ideology is going to be our focus. This is a very ideological space. And sometimes that hype gets investor eyes, right? You get the maxis, you get, whatever you want to call it. But there's going to be a point in time where it makes sense to sell the Bitcoin. Not all of it, maybe, but some of it, a little bit of it, or all of it, right? And it's going to come down to market movement. And then there's going to be another point in time where it's going to make sense to stack everything you can all over again, right? I think we're in a building cycle. So it's going to make more sense to hold the majority of our Bitcoin than it is to sell it, with the exceptions of opportunity cost, right? There's an opportunity tomorrow that there needs to be $100 million for, and we have a lot of Bitcoin. We're going to measure the levers, is how we've always referred to it, ahead of us. Debt is a non-existent lever right now. So it's Bitcoin or equity. And right now, the fact that we can mine Bitcoin at 36,000, take the accretive approach. You look at last quarter, over $100 million in gain to our shareholders came from just holding Bitcoin on the balance sheet. It's a pretty convincing reason to keep it there. So, but when the tides turn, we may be the first one that sells it. So, because we were last time. It's just Treasury. It's to be used. It's an asset. We're not going to get ideological about it, but that's how we see it.
All right, thanks.
Mm-hmm.
Thank you for your leadership through these waters. I'm sure that there have been times that you've had to make some pretty tough decisions, and you have all the opportunities, but if you don't have the right leadership and the right foresight, so thank you guys for that.
Thank you. Thanks for being the first dollars. That's belief right there. Back row.
Jerry Gross, retail investor. My question to the leadership team is that, are there any initiatives on the table that you, the board of directors, are considering for increasing shareholder value that you can share with us?
There's very little that we can share that hasn't already been shared. But what I can say is we've made some pretty broad statements that we are highly focused on growth. I want to put that in a little tighter context, though, and the whys. Time value of money, right? When the next bull cycle hits, it's going to hit hard, and it's going to be too late. It's going to be who's in the right position to take the most advantage of that hash rate, because it's going to be too expensive to go buy something then. And so it's about laying the foundational groundwork right now. So we are heavily focused on making that happen. I believe that the next kickoff where a true bull cycle kicks off, and again, to your point about the super cycle, I think the ETFs have interrupted it. I don't think it means it's gone away. I do think that, on average with macro events being all equal, we're seeing like 2 years and 2 years. Seems to still be something I'm believing in. But I think in the next 7 months, at some point in time, the door closes. So it's about doing things now and moving quickly. So that's going to be our goal, is, just like you saw with what we're doing in Wyoming, we're looking for more opportunities like that. We're looking at both planning for having opportunity to keep building, because once you own the dirt and the basic infrastructure and the miners, it's cheap to build, but it takes time. So we're going to try and also grab a lot of turnkey infrastructure. There's a lot of distressed assets out there. Can't tell you anything specific, but we have commented that we're looking at a lot, and we're passing on 9 out of 10 opportunities. They just don't make sense for our portfolio for a lot of reasons. Some of the other miners can pick them up, and we use a measurement on that. We always say before we put a deal down permanently, we say, how are we going to feel if we read about it in the paper, as if anybody reads a paper anymore, but see it online, that somebody else bought it. And if we feel good that we passed on it, even though we saw somebody else did it, then we know that we made the right decision. So that's actually how we judge things we put down. And we have seen headlines on facilities that we passed, and we felt good because we knew the reasons we didn't buy it. So just know that we're hard at work, and we think that now is the time to grow.
And Jerry, to add on to that point, not this December that just passed, but the year prior. So what is that, 17 months ago? Our stock was trading below $2 a share. And so when we talk about returning value to shareholders, we tend to have a little longer look. The movement from 20 to 16 is painful in the short term, but one of the things you hear about when you look at the talking heads on CNBC is when a market has become overheated. And the challenge is that market forces are driven by Econ 101, supply and demand, right? So it's kind of what's driving Bitcoin price, but that's also one of the things that drives CleanSpark price. So we have the benefit, Brittany gets updates from NASDAQ every month, and it shows rotations. So when an institution rotates out of a firm into a firm, we get reports when they file their 13D filings, when they sold, what they had before, what they have now. And so it's just part of the cyclical nature when a fund, for example, WGMI, it's the Bitcoin miner ETF. So when WGMI started, it was all of the companies had about equal footing. 8 or 9% of the fund was, CleanSpark, Marathon, Riot, all the different funds. And Zach and I were fortunate to develop a real strong relationship with Leah Wald, who owned Valkyrie at the time. And when Leah built that position, and then Dan Weiskopf through the Block ETF built their position, we started out balanced. So everybody had an equal position in those funds. But because since December of last year, our stock has gone from 2 to 20, the percentage of those funds became outsized. So the concentration in those funds was disproportionate when you look at a fund being a balanced approach to the industry. So when a guy like Dan Weiskopf calls me at night and he said, Matt, just wanted to tell you thank you. Appreciate what you guys have done. You're going to see that we sold some stock. It's not because we don't believe in you guys. It's because you've now become almost our entire fund, and that's not really the purpose of a fund. So we outgrew ourselves. So then what happens is you have these institutions that move out of some of that position, increasing the supply that's available on the market, puts a little bit of pressure on the price. So a combination of that, and then the headwinds facing Bitcoin. You can't go a week without some, article coming out in the New York Times that talks about, well, Bitcoin mining consumes more power than the Western United States. Well, how do you come up with that metric? So a lot of Bitcoin miners are powered by hydroelectric power. The New York Times metric for gauging that is they counted water flowing through hydro dams as consumed power. Now, correct me if I'm wrong, I've been on the inlet side and the outlet side of a hydroelectric dam. It doesn't consume anything, but it's a convenient argument if you don't like Bitcoin. So we get crazy little headwinds like that create a blip. The Federal Reserve rattles their saber. They get a little bit negative in sentiment. Capital flows out of the markets. There's pressure on the stocks. Bitcoin miners are more of a speculative investment. We tend to have a little more volatility when macro events like that happen. So we look at it big picture, not as a snapshot just today or just the last few weeks, but we look at our growth incrementally over the longer period of time. And, we're tasked with being the most capable and wise stewards of your capital that we can be, because, quite frankly, if we don't do our job, somebody else is standing in the wing to do it better. And so we make those decisions in real time to make sure that we're addressing that. So thanks for that question.
Thank you, Matt, for the response.
Yes, sir.
Larry Stewart, thanks again for today. AI is pretty hot right now. I anticipate that there's going to be competition for energy, and AI is going to bring a lot of that competition. I'm curious how you perceive that going forward, and also some of your competition is diversifying their interest into AI also. Are you considering that at all?
That was a hot topic of yesterday. And here's what I'm going to say about diversifying when you're a Bitcoin miner into AI. It means you're not very good at Bitcoin mining. And that sounds harsh, but that's exactly how I feel. I believe that the best use of power, I think we're wasting power if we're not mining Bitcoin with it, right? And I think doing one thing really, really well is important. We may be the only Bitcoin miner that actually owns brick and mortar level facilities that could actually support true AI in metropolitan areas. You're in one right now. We decided to, of course, do what we're going to do, but you're going to see it's on raised floors. We could actually, if we so chose, which I wouldn't do, we could convert this building back in and we could do AI. And we actually, being in a metropolitan area, would have low latency and it would probably be successful. At College Park, we actually have a 44,000 square foot brick and mortar facility that we could immediately put AI and things in there. We don't do it. Instead, we run a very small amount of miners in the facility, but we actually run everything else. We're using that power, we believe, for better purposes outside. Now, the interesting thing about AI is there's a lot of hype that talks about, oh, we have these huge contracts, there's things we can do. When you consider that you have to have now a sales team, you have to have customers, you have to have customer relations, you have to do all these things. And then you end up with requirements in your contracts that if you don't have the uptime you're supposed to have, there's penalties and so forth. So it's a complicated thing that doesn't come without risk and without a lot of cost to support it. And then the next thing you have to consider is, if you're going to choose who you're going to compete against, I just said that our competition is global hash rate, and it's about growing instead of if you're shrinking in this field, you're dying, and it's our job to grow. If you go to the other side and you talk about AI, your competition is Amazon, Meta, et cetera, et cetera, et cetera, with billions and billions of dollars of assets and the political abilities to outmaneuver. Do you really want to be in the space to be competing against that? I think it's not worthwhile. Now, what I will say was interested, a lot of institutional investors are interested in, is the fact that we do control so much power as miners. So it is going to be this kind of banked asset that will always be in the background. And the other thing too is we have sites, they're 86 megawatts or 230 megawatts or things like that. A lot of true AI data centers that want to be in metropolitan areas and have low latency, they want to be there for a specific reason. They don't need 100 megawatts. They need 3. They need 8. They need 10. We could always partner in the future, which could be a much more simple way to have access to the power, do something with it. But it's nothing that I'm interested in doing, nothing the company's interested in doing right now, because it would be, I would believe it would be a distraction, a very complicated and costly distraction that you think of right now, the dollars we spend, again, Matt mentioned we want to be stewards of that capital. It's our job to turn that into value. If I'm going to go into AI, I need to spend a massive amount of dollars on those data centers to upgrade them. And then I need to hire a team. I need to do research. Sometimes when I'm talking about our peers and I look at some of the things they're doing, I refer to it as their science projects. How many tens of millions of dollars are they dumping into things that they don't know if they will or won't return? So that's my answer on AI. A little long-winded on that, but I do feel strongly that staying focused has a tremendous amount of value.
I think there's also a correlation in the market. Companies that made strategic investments in infrastructure and equipment ahead of time, companies like CleanSpark, like Marathon, like Riot, like Bitfarms, that have access to machines at favorable pricing and have secured power, aren't talking about AI. The companies that are talking about AI, coincidentally, are the ones that didn't strategically make investments in new equipment. So as their efficiency, the joules per terahash, climbs, it costs more to mine a Bitcoin, AI, for lack of a better term, becomes a new shiny key. Let's take a look at that. Our job is to return capital to you, and we think we can do that better by being the best at one thing. Hold on, right here was next, I think.
Okay.
You guys, I think it was a couple earnings reports ago, mentioned about opening a trading desk in-house to sell covered calls on the Bitcoin or some short call strategy.
Mm-hmm.
I haven't heard any updates since then. Is that sort of in lieu of de-risking the balance sheet at, some perceived peak in the bull phase, or is that, to go in tandem with, or can you just add some more color to that?
Yeah, so it's when we announced, we talked about getting it done, I think in our February earnings call, we wanted to wait till after halving. Well, we're after halving now, right? So what we see as the main purpose for it is to generate some additional yield right now, right? Right now, the best use of our Bitcoin is to let it sit, grow, appreciate. There's going to be some downside protection we want to put in. There's going to be some long-term upside, from covered calls that can generate revenue today that still allow us to keep it on there. We want to bring that in-house though, because it's really easy to say, oh, we're gonna run a trading strategy, and I'm gonna call up XYZ person. They're never gonna care as much, just like all of us. Somebody you let manage your money is not going to care quite as much as you are because it's not theirs. But in order to do so, we want to do it right, and we want to make sure we have true professionals that are running it. So we're building it out right now. We'll have more on that, hopefully soon. Probably in the next earnings call, we'll discuss it further. But we are approaching it slowly because, again, we don't want to rush this. We're not looking to use this desk as just taking a bet on, hey, we're going to, make some crazy bet on calls at 200,000 or something, right? It's about just adding a +1 to the capital management strategy that we believe is already going very well.
Right.
Yeah, pretty good.
Any follow on from that?
Selling volatility or selling covered calls during a phase or entering a phase with potential upside potential could seem not wise, as opposed to just sitting and holding.
Yeah.
But then you mentioned about potential downside protection. I guess it's really hindsight's 20/20 as to what
Always.
the right decision would be
Yeah.
going forward. You guys did a good job last cycle doing that. So really nothing else for me at this current time.
That's right. And to be clear too, we would really look at short-term things. So for example, you take a covered call that you sell out of the money. You actually hope it stays out of the money. You don't really want to deliver the Bitcoin. You just want to take the premium and bank it. So we would look to short-term things, and really we would look to it to the extent that we would be happy to sell at that price anyway on any given Thursday. For example, you take a 2-week covered call, take the premium, and you say, hey, if Bitcoin goes to 80,000, we're fine to sell 100 Bitcoin at 80,000 while we sit here at 68, right? That's the strategy. Low risks, things that you're very happy to follow through with anyway. But also there could be a value of, turning 10 Bitcoin over in a single day. That's a very, very small amount of our stack. But if you turn it over enough, you can generate something over 365 days that you start to cover a piece of the OPEX and start to chip away at it, right? We're not looking to make big bets. We're not looking to bet the farm on anything. This is small, incremental, very, very conservative compared to if we were just like a hedge fund trying to generate the most yield on Bitcoin. That's what happened to a lot of people 2 years ago, and it wiped them out, right? We are not looking to do that. I just want to be really clear.
What would the counterparties on these type of activities be? I don't see much liquidity or really anywhere to trade options on spot Bitcoin. ETFs don't have options yet.
You're 100% right. Yeah, it would have to be over the counter, and that's the thing is the counterparty risk becomes the biggest thing. So with big enough accounts, you can do some of these things on Coinbase, but again, it's limited liquidity. You have to really pick your bets and not bet too hard. There's some exciting things with CME coming out, talking about offering some products. In addition to that, I think that the banking law is changing that allows traditional banks to custody Bitcoin and other digital assets. I think that will change the market completely. I think liquidity for secondary products will improve. Now that comes with the double-edged sword. I'm a believer in holding Bitcoin, not products that can become Bitcoin. So that's going to come with its own problems. There's then going to be people that choose to buy calls instead of Bitcoin, which could affect the price. But that's just going to be the way that markets work. It's how TradFis work. We're going to get a little bit of that layered on top of Bitcoin. And I think it will increase adoption. And that's ultimately what matters, which ultimately means it's good for Bitcoin. Yeah, no, thank you.
Sorry, go ahead.
Yes, I'm Daniel. I've got a couple questions. One follow-up with that.
Yeah.
So on the flip side, would you guys also sell puts too?
We would look at the strategy in a diversified strategy. The goal would be largely collared types of products where you try and get some volatility in the middle, but you don't want to lose it all, and we're not going to try and hit home runs every time. So it's about really trading in bands and creating very low risk products. So that does usually mean you're going to pair it with multiple products to kind of create that band.
And then, changing topics here, would you guys ever consider, at one point, like, do you start thinking if it's worth going to like a solar farm, for example, and storing energy, having that type of a system in-house? Like, would you ever?
Yeah. So our background being, a microgrid company, we understand the systems well. We used to build them. Batteries are still cost prohibitive, but you don't really need a battery when you're a Bitcoin miner because you end up being the consumer that just turns off and then we send power to the grid. It's almost like a battery in reverse, right? Instead of storing, we're just consuming all the time. Somebody's getting paid for it all the time, but when somebody else needs it for some other reason, we just go away and it's now available to the grid. But what's more interesting when it comes to solar farms and things like that, and I'm going to asterisk there and get back to it. Part of the reason, for example, we don't have this being a solar-powered facility, we don't have 40, 50, 100 acres out back. And that's about how much solar it would take to power this facility. So instead, we participate here at this facility in the simple solar program, which means that we pay a small additional adder on our power bill that basically goes to fund building solar so that more solar gets built in Georgia. A lot of people don't know, but it's the 7th largest state for solar capacity in the country. People think of California and other states, but Georgia actually has a lot of solar powered out here. So we are consuming that, we are participating in it. But now back to what's more interesting. A lot of solar farms, when they get built, battery banks, not battery banks, whatever it may be, they sit idle sometimes for years. And that's a lot of capital that a solar farm has to have put out to build that solar farm. And they don't get to generate a return on their capital until they interconnect with the grid and there's someone willing to pay for it. So there's interesting opportunities to be able to, go out and drop equipment on a temporary basis. Temporary may be 3 years, right? But to mine directly off a substation that's connected into some very large solar farm waiting for an interconnect agreement. It does mean when they get interconnected, we may have to pick up and move on, which is why we haven't, chased it really hard. But those opportunities do exist and could be very interesting to pursue in the future. But with that said, that means you're not grid connected. You're only mining when the sun shines. So an interesting play, how I see this happening in the future, is you would take, because again, that's now a provider that is making $0. If they would agree to sell it to you for very low dollars, you take a prior generation machine that you were going to just sell out the back door to, somebody else. You keep it, you put it out there because now someone's giving you power at a penny. You don't need to have an S21 on it. The S19 works great. And you mine off of that for 8 hours a day because you don't want to take an S21 and only get 8 hours a day out of it. You want to take something that's maybe less efficient with really low cost power and take it as a bonus. So those opportunities is, I think, where we'd see us plugging into solar farms on a more long-term basis.
We have time for one more question.
Back row.
Darren Sager, retail investor from Dallas. I want to expand on Matt talking about the WGMI fund. That fund actually owns 18% of CleanSpark, most of that fund. I don't think they've sold too much of it.
Just a little bit. They were at 22 at one point, so yeah.
And then what percentage of the fleet has to be, fixed monthly? With, 1%, less than 1%?
I'm going to actually throw that one to Taylor. Where's Taylor at?
Yeah, it's much less than 1%.
That's not, okay.
Yeah, right now we currently have like 133,000 or so machines online, and we're going through less than, call it 1,000 a month, so yeah, far less than 1%.
You get reimbursed from the manufacturer?
So we have a warranty program with our manufacturers. We're actually one of the only mining companies where they have representatives on site doing repairs at David's location. And then you'll get to see our internal repair lab here that is doing all the out-of-warranty stuff. We've saved a considerable amount of money doing that rather than parsing it out to outside firms. So Vishal, one down there on the end, is the one that runs our repair lab program, and he'll be walking you guys through on the tour today to show you what his team do.
Great, thank you.
Thank you.